Yeah, well, it's an honor to be here. I'm just a labor economist, but it's nice to be here. I'll pretend that I do macroeconomics today, and it's called the unexpected compression. I'll say what I mean by unexpected and compression. But I'll start with just an observation that in the U.S., the macro response, especially in terms of fiscal policy, I think, has led to some very interesting dynamics in terms of the recovery following the COVID recession. As you can see here, the top panel shows how the GDP responded following the COVID recession versus the Great Recession. And as you can see, the recovery was very sharp. And in fact, if you compare to other countries, it was quite a bit more than what was expected in terms of where the GDP was expected to be by the IMF prior to to COVID. So U.S. sort of stands out in terms of GDP response, and I would argue that a good part of that has to do with the fiscal response, be it the CARES Act, the American Rescue Plan, led to really a different policy stance than we've had in recent times. And so all of that produced as I will show, historically tight labor market. So the things that I want to talk about today, show you some evidence on what that historically tight labor market meant for wages, generally wage inequality in particular, and on inflation. And secondly, being a labor economist, what I will also focus on is the role that tightness leads to the role that labor market competition plays in mediating the effect of tightness on wages and on wage inequality in general. All of that has really big implications for thinking about both the past and the future. In the past, because to better understand what caused the rise of inequality, especially pronounced in English-speaking countries, in America in particular, but generally, more generally, since about 1980 or so, I would argue that macro policy has played an important role, and I think I can show you some evidence supporting that conclusion. And secondly, the extent to which tighter labor market has led to wage growth at the bottom, I'll show that it has. Why does that happen? And I would argue that understanding competition in the labor market is an important aspect of that. Okay, so here's sort of the plan of attack. I'll start with the unexpected facts, especially sharp reversal in inequality that's happened in the U.S., driven by rising wages at the bottom. A conceptual framework for thinking about why that happens that really focuses on the changing competition and especially rising quits and job-to-job mobility that has risen a lot. You may have heard the term Great Resignation or Great Reshuffle. That's real, and so I'll show you some evidence on that, along with showing you where the quits are actually happening by types of jobs. And then wage growth is happening in the U.S. at the bottom, as I will show, but then it's also happening at a time with great inflation, although that's really come down quite a bit in recent months. But was there a connection where wage growth was a causally led to price growth as opposed to the other way around, for instance? I'll show you some evidence along on that front as well, and then conclude based on that. Okay, so let me get started with showing you some of the evidence. I'm going to start with the jobs rebound. And here I'm showing you what's happening to the EPOP, employment to population rate, and labor force participation rate relative to just before the pandemic. A way to think about it is, this is, by the way, for 16 to 65-year-olds. It is true that those above 65, the employment rate actually hasn't fully recovered, but that, I think, reflects more labor supply issues and early retirement. But just to put this in perspective, after this recession, employment recovered in about 2 to 3 years. It took 12 years after the financial crisis in the U.S. So it's a very different situation. But the other interesting thing is that the employment losses were much sharper for low-wage workers. And one of the reasons for that was in the U.S., we actually relied on temporary layoffs and unemployment insurance to provide relief during 2020 and COVID period, for instance, leading to much sharper job loss, especially for more public-facing jobs in hospitality and services. But the rebound was also proportionately larger. But here's the interesting thing. Based on the employment losses being much more pronounced for low-wage workers, you would not probably have thought, I certainly didn't, that we would see stronger wage growth for those at the bottom. If anything, you'd say, well, maybe the opposite might happen. But actually, that's why I say the unexpected compression, because if you think about who lost jobs, it was lower wage workers, and who are, as it turns out, also saw higher wage gains. And you can look at it by occupations. Low wage occupations took the biggest hit in 2020 and 2021 compared to higher wage occupation. But then, when you look at wage growth, it really flips the script. So here I'm showing you in the x-axis the hourly wage percentile, and the y-axis the wage change, nominal wage change in red, right, by percentile. The left column shows the change, the 40-month change from right before the pandemic to relatively recent period, mid-2023, and that's kind of the key thing. Here's a really important thing to understand. The wage growth is the fastest at the bottom, compared to more at the bottom than the middle, more at the middle than the top. That is exactly the opposite pattern that we had for 40 years. Okay? So this is really a turnaround in many important ways. As you can see, that's the long difference. If you look at more different time periods, you see broadly similar pattern, though in the last 12 months, it's still the case that the lowest wage workers are seeing somewhat higher wage growth, but though it's become more even. At the same time, this trend certainly has not reversed itself in the last 6 months, for instance. So in the blue is the inflation rate. So basically all of the groups that are, the red line is above the blue line, they're above water, so they're seeing real wage growth. And so you can see that basically the bottom 60% has seen real wage growth compared to pre-pandemic, and the top has not, where inflation actually has outpaced wage growth in nominal terms. Very surprising in many ways, because it's certainly both because it is opposite of what has happened in the past in many ways, and also given the employment patterns I show. So here I'm sort of showing you what's the slightly longer time frame, going from 2015 onwards, by 3 wage percentiles. So these are real wage trends. Blue is the 90th percentile, green is the 50th, and red is the 10th percentile. And what you can see is that, again, like I showed you in the last slide, wage growth has been the strongest at the top, followed by the middle, followed by, strongest at the bottom. See, I'm used to saying this. Strongest at the bottom, followed by the middle, followed by the top. Now, one thing you will notice, or you may notice, is that even in the prior to the pandemic, the red line, the 10th percentile, was growing somewhat faster. And that actually is true in the years right before the pandemic. However, it turns out that change was in an important part fueled by minimum wages that were actually rising in many of the larger states in the U.S. So if you split the sample into states with no minimum wage, that's 20 states in the U.S., that's on the right panel. What you see is that wage growth was actually relatively similar for high, middle, and top in the years prior to the pandemic, and then really split. So that's kind of showing you essentially how the labor market was working, had really shifted following the pandemic. We can cut this compression, wage compression in many different ways, and we have. And so you can look at it by occupation, for instance. Again, you can see the lowest wage occupations have seen the biggest real wage growth, and the opposite is true for the higher wage occupation. You can look at it by age. It's the younger workers that actually are seeing the biggest wage growth. I'll come back to that because it turns out that those are also workers who have been switching jobs the most, and job switching is a key driver, as I'll show you, of this wage growth. We can, in particular, make the cut by education and age together. It's the younger non-college workers, the high school under 40, that's the group that has benefited the most in their last 3 years in the post-pandemic period. So you can see the contrast between those two groups is quite large, where we've seen the high school, younger high school educated workers have seen the strongest wage growth. So we can cut it by other ways. Race, we've actually seen a reduction in the race wage gap for the first time in a while, in decades, because really the black-white wage differential sort of stalled after improving in the 60s and 70s. It sort of stalled starting in the 80s. It's the first time that it actually fell by at least a decent amount. There has been some reduction in the in wage differences by gender, because again, women tend to have lower wage jobs more, and so on and so forth. But generally speaking, we see a very broad-based compression. Now, how should we think about the magnitude of the compression? So here, I'm going to go back to that 90-10 difference, something that we often think of as using as capturing the overall inequality, in several periods. So in the far right is what we call the unexpected compression. So that's showing the log of 90-10 ratio fell by about 0.11. How does that 0.11 compare to some other episodes? So what about if you go all the way to the 1940s, the 1940s we saw the biggest reduction in inequality in the U.S. that we know of. It was coined the Great Compression by Claudia Goldin and Bob Margo. So the compression we've seen between 2020 and 2023 in terms of the log 90-10 ratio is about 45% of that episode. That's a big number. And moreover, if you look at the change between 1979 and 2019, some people have termed that the Great Divergence. That's the growth in inequality in the neoliberal era. Well, this 90-10 ratio based change in the recent period is actually about, something like 35 to 40% of the increase in inequality was reversed. So that's, again, a pretty big deal in terms of the magnitude. So it's not just that inequality has fallen, but the extent of fall, at least measured by the 90-10 ratio, is actually quite substantial by historical standards. So what's driving this? Well, one of the things, as I will argue, is driving this is the so-called Great Reshuffle, where workers are changing jobs. Workers, in fact, are quitting jobs, and here you can see that the biggest increases have happened, for instance, in the hospitality sector, where workers have left low-paying jobs, and I'll show you that in various ways. Now, but this introduces a conceptual point that's really important to keep in mind. So the key question, of course, is why are workers quitting, and what impact did that have on inequality? So from a theoretical perspective, right? So there's particularities about the current context, including, for instance, maybe there's maybe there are things about the pandemic that added to this, but there's also a broader issue, which is that we have a tight labor market, and if you actually have models of labor market where workers are changing jobs and there's active competition of varying degrees for those workers, then job-to-job transitions and quits are going to be a really key component of what puts pressure on wages. And so in particular, we would expect that most of the increase in quits should have accrued to jobs that pay particularly low wages. So this relationship could be called is called the quit elasticity. In models of monopsony power, labor market power, the quit elasticity is an important proximate measure of how much market power employers have. And so we can keep that in mind when looking at the data in a few slides down. Oh, and finally, I should say that it also implies if, for example, workers are quitting the lowest paid jobs, they're also likely to be quitting the lowest productivity jobs, so there may be a positive reallocation that occurs. And so, it's sort of in a baseline model, you would expect that as you increase competition, going from the red to blue line, if you rank firms by their wage and oftentimes also their productivity levels, you should see basically job-to-job separations rising most at the bottom of the firm quality. And that's going to be the prediction. Now we can also look at that actual data in a bit. So what's actually happening in the data? Well, we see that there's been some increase in overall job-to-job separation rate, about 6% above the pre-pandemic levels, but really much bigger increases when you look at the high school under 40 group, where you see much sharper rise of job-to-job transitions, much less so for the rest of the workforce. And we can sort of think about what this is, in terms of what contribution this tightness is actually causing wages by looking across different states in the U.S. So, there's a lot of variation actually in how tight the labor markets are. So what we can do is we can actually look to see how much did wages rise in states where we saw greater tightness over this period. And by the way, this is looking at the change in real wage between 2021 and 23. And you see that generally speaking, there's a relationship. States where tighter labor market actually saw greater wage growth. But here's the thing. If you now, instead of looking at the average wage, you look at wages of high school under 40, that relationship is a lot stronger. In fact, it's for the remainder, right? It's barely a positive slope at all. But for lower wage workers, tightness is a very strong contributor of wage growth. And generally, that's true by quartiles and by many other cuts. Basically, wage growth is stronger at the bottom when the labor market's tighter. And you can look at this historically, and as we do in the paper, in the 90s, 2000s, tightness contributes quite substantially to inequality, and that is a key part of what actually has driven inequality to fall, is that we had a historically tight labor market. Now, if people are quitting, what kind of jobs are they quitting from? I told you sort of from a theoretical perspective, we would expect the kind of the crappiest jobs to see the biggest increase. Well, that actually turns out to be true. And you can see that in particular by looking in the high school under 40 group, where you see this is showing the job-to-job separation rate, right? Quit rate, as a function of the industry wage premium. So how workers of that with those qualifications, are they getting paid particularly good, particularly high, or particularly low? So low paying sectors, this is at the 3-digit industry level, are ones where we see the biggest rise in job-to-job separations. So this, again, is really a key part of explaining the wage growth, because we are seeing a reallocation away from the lowest paid sectors away towards better paid ones. So how much did job-to-job change contribute to wage growth? To do that, we can decompose this. It's actually better just to go straight here. We can decompose the wage compression between high school under 40 versus all else, and that's in the red bar right here. And you can say how much of that red bar is caused by people who are changing jobs. That's the green bar. Boy, it looks like it's just about all of it. So really, this big compression we've seen that I just showed you is really driven all by people who are changing jobs. They're moving away from the worst paying jobs to better paid ones. And that's really what's caused this reduction in inequality. So fine, how am I doing on time?
5 minutes.
Perfect, just great. I mean, I rarely do this well. So then you come to this, I'm just telling you about the labor market, but now it was a macro. Well, inflation. So how much did this tightness contribute to inflation? Because you can think, well, gee, so this increased tightness led to this historic reduction in inequality. All sounds great, but we also saw historic inflation. Well, not by historic, at least by the last 30-year standard. So is it self-defeating, right? So this is sort of the worry you would have. Like, you're telling me the big fiscal did all this great stuff and reduced inequality, but it also contributed to inflation through a tight labor market. Then it's sort of self-defeating. I don't know how many people here would think that, but certainly the argument gets thrown out around a lot. So what we can do is, again, using the same type of cross-sectional Phillips curve that I showed you on wages, you can do the same analysis across states to say, well, where the labor market was particularly tight and we saw particularly higher wage growth, did prices also rise most there? Especially given that these are service sector jobs, you would think that these are non-tradable sector. Lower wage workers are more likely to be working in non-tradable sector, so prices are more likely to be different across places. They're not equalized through trade. So in that sense, do we actually see greater price growth? And here we can plot the same coefficient. So here I'm just plotting the wage Phillips curve. That's the blue line is the steepest line is basically the wage Phillips curve for high school under 40. And then in red is the overall wage Phillips curve. And the green, the essentially flat line is the price differences. So we constructed these price measures by state, and really that doesn't seem to really respond in any degree, similar degree as wages. Now, I should say that if you cut it by different time periods, in 2022 there was some indication of higher price growth in the tighter labor market, but if you look at the magnitude, it was just a lot smaller. And this shouldn't be surprising, right? Because I just told you the wage growth has been biggest at the bottom. Those are not folks who are contributing greatly to the overall prices. So compression in some ways is cheap in terms of any inflationary prediction, more so than wage growth at the top, which contributes a lot more. But in general, also, especially in the U.S., there's presumably room for raising wages that may actually shift away from going to businesses as opposed to pass through to inflation up to a point at least, right? So, in fact, we can look at the real wage Phillips curve, where by real I mean adjusted using regional prices, right? And you can see that essentially the biggest increase in real wage, even adjusting for inflation induced by any possible wage gain and tightness, has been at the bottom. So, as I mentioned, if you bound the role of tightness, maybe 15% of the increase in inflation could be in any way attributed to state-level tightness measures by our finding. There are other things I could talk about, like inflation differences across different groups, but really that doesn't explain the main finding of compression that we have. So let me just sort of finish here. I just want to leave you with, if you sort of remember one thing, like two things, the finding of compression and comparing that by historical standards, that this is actually a pretty big deal, is probably one of the most, the key finding in our work that I would leave you with. But also thinking in terms of what does this imply about how we should think about the labor market, how the labor market works. And I think oftentimes when we think about tightness, we don't, this is true for, I think, across different parts of economics, be it mainstream or more heterodox, the role of job-to-job changes and quits and understanding the labor market, the job ladder aspect of the labor market, I think is quite important to think about in thinking about the business cycle. So I will pause here. Excellent.